Okay, it's Decoding Magnificent Seven. Yeah, everybody know what is the Magnificent Seven, right? Anybody don't know, raise your hand. Okay. Everyone is here for trading and investment. Huh? All right. There you go. There you go. No? Okay. Just like a safety flight attendant who mentioned all the time, put on your safety belt. Same thing, disclaimer, yeah, do not take anything here as a recommendation or financial advice. Yeah, make sure you know your own risks. All right, the agenda for the day. So how can we participate in Max 7 using selected option strategy? That's first one. And how does option, just now you hear a few speakers, you use it to manage your risk and enhance your return. Yeah, and you want to multiply your return, well, you got to do it more, right? And then the next one is a step-by-step demo, how you use the moomoo desktop, and also a simple guide on the app. Yeah. Then the last one, Q&A, I think we'll leave it to the end. Yeah. Next. All right. So just now, the previous speaker, Isaac, did mention about Magnificent 7. There's a market cap filter, right? So why Magnificent 7 is such an important component in the S&P 500? Yeah, because you can see it consists of 37.09%. It's like a 1/3 of the S&P 500 market cap. Yeah. So whenever these 7 stocks start to move a bit, it will kind of indirectly or directly affect the entire S&P 500, other 500 stocks. Yeah. So this is the significance of the Magnificent 7. And the total market cap grows year by year, right? You can see Slick Chart 2025, now it's 55 trillion. There's so much money to be made, right, in the US market. Let's see, next. Is it working? All right. Yeah, it's important to understand the Magnificent 7 component because of these 5 factors. The first one is there's plenty of trading volume. We call it the smart money, dumb money, everyone's money is there, right? So the institution, everyone talks about Magnificent 7. That's why there's a lot of volume. And the second is clear trend behavior. So every time there's a news that talk about the tech sector, everyone looks at what? NVIDIA, Google. So this kind of showcase that whenever people look, the big player look at the buy, then a lot of people see the news and say buy, then everybody wants to jump on the bandwagon to continue buying. So that it sets a clear trend itself. Then the third one is high volatility. High volatility means if it goes up, then the bad news and Mr. Trump comes and tweet, bam, it goes down at the same time. Yeah. So then it's highly anticipated. Everyone watch it day and night. Yep. So the next one, you can use the moomoo chart. You can even overlay many different symbols to see how it compares from, let's say, NVIDIA, Apple stock, Microsoft. You can see their performance over time. Yeah, this is one of the very good overlay feature. Yeah. So Magnificent stock over the time or over the years has become very expensive because if you look at the price itself, which stock is the most expensive? Can anyone see? No, right? Too small. So right now you can see Meta, right? 586.98. So if you look at NVIDIA itself, one of the most popular stock, a full share of 176.859, it has been diluted, right? Last time it actually was very expensive. So even it has diluted, if you want to own 100 shares, it costs you 17,685 to directly buy the 100 shares. Is it cheap to anyone here? 17,000. You have that in your bank account or you have in your broker account. It's expensive, right? So yeah, so let's look at the alternative. That's the challenge that we see. We want to find an alternative. That's where options come in. Yeah. All these are the good things you can sort of take picture, just like your favorite food. Yeah, right. So buying an option and selling an option is different because you can see that as a seller, even though the stock stays sideways or go down, like selling a call or actually selling a put, you can still be profitable in the trade. But if you are a buyer, you are buying a call or buying a put, you expect the stock price to move up or down. Yeah. So that's why we use option to participate in the Magnificent 7 because of 3 factors. So the pro and con. Okay, we always have to mention pro and con. So just now, I think Kathleen have highlighted the detail. I will just re-summarize. So option itself is a very versatile instrument because it can be like a business. You use small capital to get bigger return. That's a leverage. And it can also act as a protection. It can be like an insurance itself. So you want to sell insurance policy on the stock, then you become a premium seller next. So you not only protect yourself, when the stock stays sideways, you still profit from the trade. When the stock actually stays sideways or go to the direction you want, you can collect rental income. So not only you can use option to trade it like a property, it can also act like an insurance. So it has many ways. So I like to call option as a Swiss knife. Yeah, the Swiss knife itself, of course, comes with a risk. If you don't know how to use it, you can cut yourself. So you can experience total premium loss. You can lose everything if you buy a call or put. When it expires, worthless, not according to the direction you want. Or you can also experience the most famous word that everybody is afraid of, margin call or forced liquidation. So we get that call from our customer service a lot of time when they don't know how to manage their position, margin call. Yeah. So when your account we call it, have to go to hospital, right? So then you call 911 to say what happened. I don't have enough buying power to own the 100 shares, and I got assigned. So then the last one is liquidity. So when we look at all the option chain strike price, there's so many strike price, we can see there's liquidity involved. So is there enough buyer and seller participating in the particular strike price? If there's not enough buyer or seller, the moment you can buy into the option, but when you want to come out, you get stuck. Yeah. So that's when you get stuck. And do you have to worry about that in Magnificent 7 stock? Yes, for some of the strike price, yeah, not a lot. Because Magnificent 7 has very high liquidity. Okay, so just to jog your memory again, basic option strategy. There's also generally there's 3 types, right? Buying a call, expecting the stock price to go up, buying a put, expecting the stock price to go down, and also collecting the premium when you sell a call and sell a put. All right? Yeah. So who has done one leg option? Raise your hand. One leg option, yes. All right, good. 2 leg option, 3 leg option, 4 leg option, 5 leg, 6. Oh, okay, I know. So a maximum 4 leg. Iron condo. Oh, no. All right. All right. So with any leg, most important is you must master one option strategy at a time. So one of the most basic option strategy is buying a call. So I won't go in detail because just for your info is to know that you can use small capital. It's just like buying one call option to actually take control of a bigger ticket item, which is 100 share. So this example is like I buy 100 share, I need 20,000. When I buy one call option at $5, I need $500 to control 20,000 stocks. So this is why the pro is I can amplify my return using a small capital, but at the same time, I can lose it all. Yeah? So this is the first benefit. So one of the example when we apply in the Magnificent 7, I look at NVIDIA, okay? This is a $180 stock price example only, yeah? So how is it the same using the same amplification, applying it to a $100 stock versus a $400 stock, which is like Tesla, the next slide. Yeah, this example is to show, if it jumps, okay. Oops, yeah, correct, thanks. So it's just to do a comparison when you buy a stock outright versus you buy a call option. So if the stock price is at 180, I buy at 180 call, that's buying at the money. So when I buy at the money, what is the pro? The pro is I can leverage the capital by using $800. So if the stock price move from $180 to $200, so what do I get? The option value changed from $800 to $2,000. And this is the stock price minus the strike price for what amount I paid. So the profit is 2,000 minus 800, I get $1,200 profit. Yeah? So this option value minus required capital, what is the return? It's 150% leverage return. Yeah? Compared to a 11% return by buying the 100 shares. So this is buying a call. Yeah. So what if the stock price is more expensive? If it's a $450 stock, like Tesla, so you can also use the same required capital, $800, but you can choose the strike price you want. So now let's say Tesla stock price is at $450, you can actually buy the option at $430, also worth $800 required capital. And you can do the same thing. You expect the stock price to go down, so $450 to $400, you can realize a profit of $2,200. Yeah, get it so far? So which means regardless of the stock price itself, you can choose the strike price based on the budget you want. That's the key lesson here. So that's the beauty about the flexibility of your costs. The flexibility of using option to hold 100 shares. Okay. So this leverage shows that we only need around 1 to 5% of fractional of the share cost to actually participate in the Magnificent Seven stock itself using options. Is it good? Yes, great. Yep. So that's why you can actually, instead of owning the share, you can actually buy more than one contract. But if you buy one call, means you are controlling 100 shares. If you buy 2 call, you're controlling 200 shares. Yeah. So over here, if you have only 1,000 budget, you can actually buy a call or buy a put. In this example, for NVIDIA and Tesla, to participate in the Magnificent Seven using option. Yeah? So that's the leverage. So the next benefit is actually protection. Protection is all about looking at market fear, like VIX index, that spike up, or you can see the stock market goes down. What is going to happen? So you need some hedge. So this protection itself, if you look at the CNN, you say, market is in extreme fear. So what am I going to do? So this is a bit of a next pop quiz. So what am I going to do if market have very extreme market fear? Anybody want to give it a try? Buy put, yes, and common strategy, sell put. Sell put. Great. Yeah, because you want to hold a share for long term, that's fine. And you want to sell a call, also can. Just like making it a covered call if you hold 100 shares. So no one strategy is a perfect strategy. But the common one is buy put and sell call, because you are looking at the price to stay the same or going down. These are some of the common strategy to hedge against market downturn. Yeah. So buying a put and selling a call, some people have a bit of a dilemma. Do they want to take limited risk or unlimited risk? That's one of the key difference. Yeah? Do you want to be an option buyer or option seller? So next is I'll show you some of the tools we have that you can actually choose wisely so that you can decide for yourself. Yeah? So the next one is the third benefit in option is collecting so-called rental income, or we call it premium. So this premium income comes from where? It doesn't fall from the sky. It falls from time value, time decay. So every option has a premium that will decay over time. Yeah? So if it's a shorter time expiration, then the option tend to decay faster. If it's longer time expiration, the option tend to decay slower. Yeah? And then the third advantage on the premium that you collect over time is the volatility advantage. So when we look at the VIX, if the VIX is from 25, suddenly it comes down to 20. The overall broad market, when the volatility goes down, if you're an option seller, you can realize the profit faster. Yeah. So these are some of the benefit on being an option seller instead of buying. But of course, it also comes with the unlimited risk. If your account is not big enough, you may experience margin call. Yeah, if you get assigned. Then your margin requirement, early assignment, all these things are consideration that you must be very aware of if you are selling option. Oops. Yeah. So one of the common strategy that people sell option is basically the one-leg option, we call it, which is a wheel strategy. So wheel strategy is because we are looking at Magnificent Seven. Most of the stock in Magnificent Seven, they actually trend upward over a long period of time. So a lot of option trader, they want to sell option naked, I would say. They like to sell and collect the premium while waiting for the stock to go up or go down in price. So this is called view because let's say the stock is at $5, I sell the, let's say the stock at $10, I sell a put premium, collect the premium at $5, then the stock price go from $10 to $20, I sell a call at $25, I collect the premium, then I continue doing that until I get assigned 100 share. So I continually do this so that I can collect the premium rental income while I wait for the stock price to come to the price I want it to be. So it goes on and on and on. Yeah. So this is how one of the view option strategy shows that option selling is a big advantage. So we go into the desktop app feature so that you can experience the benefit of option. All right. So I like to set framework, just like process, right? Yeah. So this process that I set for myself is GOAL. All right. Who likes to trade? Who likes to trade with the time frame in mind? Or basically, whenever you enter a trade, in your head you tell yourself, I know how long I want to hold the trade. It's like I know my time frame. I want to go long term or short term. Raise your hand. Time is very important. So that means okay, in 30 days I will take profit, and if the trade doesn't reach my profit target, I will close the trade. Right? That's the time frame. So the other type of trader is budget. Some of them, they are very budget sensitive. Yeah, they say money is very important. Huh? If I lose $1, yeah, it's very important. I need to know where the dollar goes. All right, I lose it in which shares. So who feels budget is very important? Like I set a $500 for this trade, and that's all. Yes, so for those who choose budget, so then you will actually go for budget. So the first step is G stands for you must set your time frame or budget in mind first. Your goal. What is your goal when you trade? Make your first trade. And the second one is you outline. You got to outline what is your filter. Just now, some of the speakers already mentioned there is strike price all the way to your grid. And it also could be your premium. Yeah, there's many factors. Then the third one is you want to analyze whether the option price is cheap or expensive. So you want to see whether the premium is at the price that you want based on your budget. And we also have a very interesting feature is expected move. Yeah, for those who are using moomoo app, you may not see this. Yeah, only desktop have it for now. Then the last one is once you are aware of your risk reward for the option premium you pay, you can log in the trade and see how your option plays out. Yeah. So this is GOAL. So the first one. Okay. So anybody here has used the moomoo desktop before? Raise your hand. Yep. Not a lot. So anybody who don't even know we have a desktop version, raise your hand. Yeah, I get that feedback. Some of them were so surprised we have desktop version. They say, wow, amazing. Yeah, it's always there. This is the moomoo NX version. So first step, select option expiration. You must look on your left-hand side. You can see the expiration. Yeah. So there are some stocks that have 0 days, 1 day, 2 days, 7 days. Then they have weekly options. We have quarterly options. Then there will be W and Q indicated on the option chain. So this is for people who like to trade based on time frame. Then the second one is, this is a very cool feature, only available now on the desktop. You can set the budget you want. So when you scroll to the, let's say, NVIDIA stock, go to Strategy Builder, set the direction of the trade. If you are very bullish, then you can set the budget you have. So if over here, I give an example. Let's say I have $500 budget. Then the Strategy Builder will auto-suggest the strategy for the option strategy that you want to participate in. That means you can afford to participate in. So over here, it actually suggests long call spread and short put spread. And the maximum loss is stated there. Yeah? Then you can choose. Yeah. So this is a bit like going for the set meal instead of the a la carte. Why? Because a lot of people get confused. So if I'm bullish about the trade, what kind of option strategy is out there? Yeah, so this is a very good feature. They can do that. Then for those who who are looking at the next thing, which is outline. They want to outline the kind of criteria they have for the option trade, so they can actually go to the field setting and edit the column they want. Some people, they like to see the mid price. Some people like to see the IV. They can actually change the positioning of it so that they can look at the option chain more easily. This is based on single stock filter. Yeah? If you are very specific, you say, I want to trade NVIDIA, I want to look at the option chain, then I look at the field setting. This is on single stock filter. Then the next one, if you have a bunch of stock that you want to trade within a sector, you can go to the option screener. Option screener allows you to screen. Let's say you have less than $500 capital. I want to engage in I want to look at the option that have more than 30 delta at a certain liquidity, like maybe more than 500 volume for NVIDIA, Tesla, Microsoft. Then you can filter out those 3 stocks that have all this particular strike price, and then you can save your research time. Yeah, so you don't have to look at so many strike price. Yeah, it all goes with your outline filter on whatever criteria you have. Okay, then the next one. So option premium. Yeah, so you want to know how cheap, how expensive the premium is. Then the next step is we compare the past, present, all the way to the future, right? Your forecast value. So if you want to buy an option, we want the premium to be as low as possible, right? You want to buy cheap premium options. But is cheap premium always good? Not necessary, yeah? So, but this is a way how you want to see the past option premium. You can double click on any of the strike price. Then you can see the option chain itself, and then you can see the particular strike price on your left-hand side. Previously, there's a low and a high, right? You can see the value. So for this particular 185 strike price, the low was at around, can't see, around $2. Then it has gone up to $20 before, if I'm not wrong, right? At $12 before. Yeah, so for those who have bought at $3, they could have profit when they have taken profit at, is it $10, $12. So you know, oh, this has happened before. Then this is based on the past price. So what is the present price? You look at the last candlestick at the end. That will show on your option chain itself. We have a bid, mid, and ask price. Yeah. So you can adjust with your option price filter. So there is a mid price. If the mid price is at $4.30, it means it's in between the bid price and the ask price. The buyer price, seller price. Yeah. So $4.25, $4.30. So now the mid price is at $4.30. Yeah. So this is how you gauge your option premium, the past price versus the present value. Then the last one. This is where why I like to use the desktop version, because we have a very nice option premium curve, I would say, a visualization curve. Yeah, because as we are human, we like to be visual, so we can understand the price range. When the underlying price changed from $190 to $200 for NVIDIA, and if you are buying a call, you know that there's actually a break-even point. The break-even point is the blue color dot, 189.275. The premium you pay is $4.30. So you're buying a call at $185, so you plus $4.30, so your break-even price becomes 189.275. So that's your break-even point. So as long as NVIDIA stock price go above $189.27, your option premium actually increase in value, and you are buying a call, you will profit from the trade. Yeah? If it goes below it, you can see the dotted line and the visible line. There's 2 lines, okay? The dotted line is the current P&L. Then the visible line is actually the option value upon expiration, when it loses the total value itself. So that's why you can see that right now, as long as the stock price stays above $189 above, and you buy a call, then only you profit. Yeah? Anything less than that, it will lose value. But because the option hasn't expired worthless, you can see the red dotted line is on the other side. You can see a dotted line there. $181 is your current break-even price. Then your blue color dot is your future break-even price. Yeah, so you can use a curve, and you can even visually or use your mouse to actually move the buy call left and right. Yeah, so it's very dynamic. So instead of using those option calculator, you say, what will my option premium be if the stock price go to 195? Then you got to use a option calculator to calculate it. That's we call it the older way of looking at your future option premium price. Yeah. So if you want to use this, you can try the desktop version. And then you can, you have also other filter. Like I put up the expected move. Expected move is the orange color line. So you can see, based on this contract, it has, I can't see, 17 days expiration. So in the next 17 days, the stock price, based on volatility calculation, the system will calculate itself. There's a formula. It will go up to the orange line, which is near the 192 or 172. So that is the price range that the price will travel in the next 17 days. So this is the expected move that you can turn on and turn off. Then the left-hand side is the expiration date. You can do a time traveling forward. Let's say in the next 7 days, how will my option premium works? Yeah. So let's move on to the next one. Yeah. So after you set know your option premium, the last is your risk reward. So if you are doing single leg option, you can actually click take profit or stop loss based on the target you want. So you can preset all these things before you enter your option trade. Yeah. So that completes the entire goal setting for your option trade. Then the next one. Yeah. So this is a step-by-step demo for common single leg option. So if you want to take photo because of time limit, then I'll show the chart. Then you can look at it. Yeah. Long call, long put. Yeah. This 4 strategy. Long call, long put, short put, call. All right. Next one. Yeah. Take photo. Long call. So all this is based on price. Okay. There's a process itself. So every time when we use the app version instead of the desktop version, you can also follow the same process, which is PRICE, the 5-step process. So the first one is you pick your expiration first. Yeah. Then after that, the second step is you actually outline what you want to look at, your strike price, your Greeks, and all these things, which is your R. You review whether this is suitable based on your investment risk. Then the third one, you inspect the bid-ask spread to make sure it's liquid. Then only you make sure you choose the right direction. Is it buying an option or selling the option? Then the last one, you examine your P&L curve. Yeah. So this is the app version. It's smaller compared to the desktop version. Yeah. So this is long call. It's actually to anticipate the price to go up. Yeah. Then the second one is the long put. Yeah. Long put, same process, price. Yeah. Then you can take photo. This is expecting the stock price to go down. Then the next one is short put. Some people like to just sell the put, like doing the wheel strategy. They want to sell the put. They want to own the 100 share at the discounted price. And they can go through the same process. They got to make sure C is sell. That's all. Yeah. Then the last one is covered call. This is the strategy that I'll share more later. That means you must hold 100 share before you sell a call. So that's why it's called a covered call. The other strategy, you can purely buy the option or sell the option. Yeah. This one, you must ensure you hold 100 shares. Yeah. Then the last one is, you want to try the strategy, make sure you paper trade. Yeah. Try it out, see how the option price change over time before you risk your real money. Yeah. So that's the paper trading. Yeah. Free money, $1 million account. Don't come and say you make money from this and come to us and say you want to claim your real money. All right. This is paper trading. Okay. We have one customer who did that last time. I wonder. Yeah. You never know, right? Strange. Yeah. So it's paper trade, paper money, fake money. All right. Yeah. So that ends my session today. So yeah, make sure trade wisely. Yeah, trade the edge, not the hype, and enjoy your day. I'll pass the floor to the next speaker.
Thank you, Alvin. Can we have another round of applause for Alvin, please?